Without a single share for weeks, he takes a closer look. The sunny summer camp of the bull market was filled with powerful athletes, but some were stronger than others. The bear market turned the sunny summer camp into a hospital. The great majority of stocks were sick, some more so than others. When the break came, almost all stocks had been hurt or fractured. He reasons that if a stock has fallen from 100 to 40, it will almost certainly not climb up to the same high for a long, long time. It was like an athlete with a badly injured leg who would need a long period of recuperation. You cannot make money buying a stock and cheering it on. If one horse is going to win, it will win, even if thousands of onlookers are cheering for the other one. Jones and Laughlin had convinced him of that. He could remember himself pushing the stock upwards in his mind with no avail. He just stays on the sidelines and waits for better times to come. He firmly refuses to trade. He uses quotations from barons to detect those stocks that resist the decline. He reasoned that if they could swim against the stream, they were the ones that could advance most rapidly when the current changed. Certain stocks begin to resist the downward trend. On closer examination, he found the majority of these were companies whose earnings trends pointed sharply upwards. Capital was flowing into these stocks, even in a bad market. The capital was following earnings improvements as a dog follows a scent. He realizes that stocks are slaves to earnings power. He decides that while there may be many fundamental reasons behind any stock movement, he would look for one fundamental reason, improving earnings power, anticipation of it. To do that, he would marry his technical approach to the fundamental one. He would select stocks based on their technical action in the market, but he would only buy them when he could give improving earnings power as his fundamental reason for doing so. He decides to take a 20-year view. He looked out for those stocks which were tied up with the future and where he could expect that revolutionary new products would sharply improve the company's earnings. Certain industries were rapidly expanding, and unless something unforeseen happened, their expansion should soon be reflected in the market. In the years before automobiles, the smart operators went into railroads. They knew these would supersede the covered wagon and the stagecoach. A generation or so later, the shrewd investors moved out of railroads into automobiles. Forward-looking, expanding companies like General Motors and Chrysler were comparatively small firms then, but they represented the future. People who bought General Motors and Chrysler at the time and stayed with them during early expansion made a lot of money. These are well-established stocks by the 1950s. They were not for the forward-looking speculator. Stocks which promise future development might be worth 20 times as much in 20 years. Women's fashions alter. Women will raise or lower their hemlines 1 or 2 inches roughly every 2 or 3 years. The same with stocks. While the fashion persists, the forward-looking investors get in and stay in. Then slowly the fashion fades and they are out. They're putting their money into a new style stock like an automobile which can also fly. How to buy into this year's fashion? He could only do it by carefully watching the market for signs. What he had to do was to find stocks that would be hoisted up because they stirred people's imagination for the future. He carefully watched this general bracket of expanding stocks and new industries in tune with the jet age. He was not interested in the company's individual products. In fact, he didn't want to know what they made. That information might only inhibit him. He did not care what the company's products were any more than he was influenced by the fact that the board chairman had a beautiful wife. But he did want to know whether the company belonged to a new vigorous infant industry and whether it behaved in the market according to his requirements. But he did want to know whether the company belonged to a new vigorous infant industry and whether it behaved in the market according to his requirements. Directly against the advice of many financial writers with conservative backgrounds who have been pounding into investors for generations that they must study company reports and balance sheets, find out all they can about a stock's background to make a wise investment, he made up his mind to buy high and sell higher. Using his hard bot training, he attempted to find those expensive but cheap high-velocity stocks. He searched constantly for them because he felt sure that they would move up on the first sign of a better market. He carefully watched a dozen stocks which seemed to be in this category, checking their quotations every week, analyzing their behavior for any sign of hardening. He closely observed their price action, and he was on the alert for any sign of unusual activity as well. He'd not forgotten the importance of volume. He prepared to operate in higher price stocks because of brokerage commissions. It was cheaper to invest $10,000 in a $100 stock than in a $10 stock. Discount brokerages have solved this problem today with low flat fees. $10,000 in one stock could buy 1,000 shares of a $10 stock with a $300 commission, 500 shares of a $20 stock with a $250 commission, 100 shares of a $100 stock with a $90 commission. W.D. Gann made the same point, but in reverse. Gann also bought low-price stocks displaying positive price impact. If his buying point was correct, the broker's commission was not important. It came off of his profit. But if his timing was wrong and he was stopped out, that was another matter. Then the two commissions, one for buying and one for selling, had to be added to his loss. His mistakes would be less costly if he bought higher price stocks. It could not sink forever. As he watched the market continue sinking, he knew that it could not sink forever. Sooner or later, stocks would begin to move upwards. They always had. Bear markets were always followed by bull markets. The educated art was to watch for the first signs, be sure they were real, and buy before everyone else noticed that the prices had begun to rise again. His mind went back to the Battle of Waterloo in 1815. A recent loss at Quatre Bras had generated an overwhelmingly pessimistic investor sentiment. If England was indeed lost to Napoleon, any securities issued by the government would become immediately worthless. At this famous battle, Nathan Rothschild had an agent who, as soon as victory was certain, set off for London as an informant. After first depressing prices by short selling, Nathan Rothschild started buying every British government share he could before anyone else heard the news of English victory. This British government share is a consolidated annuity, a console. When they did, of course, the console price rocketed in value and Rothschild sold at a huge gain. The principle remains the same, to get in faster than the other fellow. 5 years he trained. He knew he had learned an enormous amount. His Canadian period had taught him not to gamble. His fundamentalist period taught him about industry groups and earnings trends. His technical period taught him how to interpret price action and the technical position of stocks. And now he reinforced himself, connecting everything. A jigsaw puzzle where he finally saw all the pieces fall beautifully in place. He was certain this method would prove successful in the future. He felt calm and confident, waiting for the market tide to turn. It began to happen. Reading Barron's, he noticed that while the averages were still showing a decline, as they had for several months, a few stocks were beginning to peep up, almost as unnoticeable as primrose buds on a winter day. It was still a question whether these tender shoots would survive or be killed by frost. He began to sense the end of this baby bear market. He was sure that the leaders in the previous market would probably not lead again. He had to find new ones. Later this proved right because hidden away in the market quotes during this period were some stocks which apparently were of not much interest to anybody, certainly not him. He'd hardly heard of them. It was November 1957 and these stocks were not dead. One day they were destined to wake up. Universal Products at $20, Thiokol Chemicals at $64, Texas Instruments at $23, Zenith Radio at $116, Fairchild Camera $19. You noticed a couple of those in there that are still brands today. They would leap into a new leadership of the market. They were going to make him $2 million.